Robert Maltbie, President of Singular Research. Welcome to 2026 and our year opening major market indicator, or as we call it, our MMI report. How to rebalance to maximize alpha for 2026. Firstly, a brief executive summary. As we enter the year with favorable earnings and upside revisions, we have ample liquidity, record money market balances, strong ETF net issuance, and supportive technicals. Valuation is elevated, but it's partially offset by improving earnings and still manageable credit spreads. Our MMI is at 74. This is a strong score on a scale of 1 to 100. Historically, this type of a score, it leads to, on average, a year-end return of over 10% in that ballpark. Focusing on earnings, beats, revisions, and liquidity. Market implications. The liquidity regime is powerful enough to overcome insider selling and support upside earnings re-rating. It's supported by that. Also, it's small cap sensitive, and this is a theme that has led the year off very strongly. Buybacks in ETFs reduce floats. Issuance is concentrated in large cap tech, and domestic money is rotating to cyclicals and small cap. That's why this Russell 2000 upside is real. Here are our targets. We're forecasting 7,700, or an up of 10% on the S&P 500. But where the real excitement is, this year will be in the Russell 2000. We're forecasting a base of 2940 upside and a bull of 3250, which is nearly 20% higher from these levels. Bottom line, the MMI is now being driven by one of the most powerful liquidity regimes of the past 25 years, led by 7.6 trillion in cash, 1 trillion in stock buybacks, ETF creation, and M&A float removed. The structural engine behind the 2026 bull case is very strong, driven by this liquidity, and it's why these near-term corrections are being absorbed rather than amplified. Looking at the segments, earnings momentum 80. Q3 EPS beats 83%. Calendar year 2026 bottoms up EPS estimates $310 and headed higher. We just had an update, a revision, a re-rating of GDP growth for Q3 of 4.5%. As we pointed to during our cold shower analysis early in the year with the tariffs and Doge, we felt this reshoring activity in CapEx would spur some strong GDP growth, and we're seeing it. Also, led by AI CapEx, we're seeing productivity starting to kick in too, at an increase of 2.9%, which is disinflationary. Now, liquidity is very strong, as we mentioned. We covered that already. The technicals of the market are holding up nicely with a 72 rating. And valuations and interest rates are positive. Valuations, the market the S&P trading at over 22 times forward earnings, while BBB rated corporates yield over 5%. A pretty equally balanced equation there. Now, moving in to the important elements of earnings growth, we see that there should be much more leverage in industrials, financials, healthcare, retail, issues that have not played ball during this early stage bull market from 24 and 25, led by AI and that concentrated regime. This Magnificent Seven is starting to flatten out and is now being outperformed, as we have called for, a broadening in the market and an outperformance by small caps, micro caps, and the general 493. We expect this trend to continue for the balance of the year. So visit singularresearch.com, sign up for a 30-day trial engagement, and receive a stream of our top market performing ideas and sector commentary. We're focusing on metals, and we feel uranium is going to be one of the top performing metals, outperforming silver and gold this year, as we see that as the corollary of oil in 1920 to power this great AI revolution. I'm Robert Maltbie, on location on the Pacific Ocean. Thank you very much.